Hey everyone, this is Jack speaking. Today I'll be explaining what is IPO or Initial Public Offering, and at the end of the video one of you who has subscribed to my channel is going to receive £100. So what exactly is IPO? Initial Public Offering, which is what IPO stands for, or a stock market launch, is a type of public offering of shares of a company to institutional investors and also retail investors, which is individuals. IPO is underwritten by one or more investment banks who also arrange for the shares to be listed on one or more stock exchanges. The biggest IPO lately was of one of the largest petroleum and natural gas companies in the world by revenue, Saudi Aramco. On 11th of December 2019, its shares worth 1.5% of Aramco's total value began trading only on Tadawul, Saudi Arabia Stock Exchange. Soon after the company went public, its total value hit $2 trillion. Through IPO, also known as floating or going public, a privately held company is being transformed into a public company. Initial public offerings can be used to raise new capital for companies. Also to monetize the investments of private shareholders such as company founders and private equity investors, as well as to enable easy trading of existing holdings or future capital raising by becoming publicly traded. After the IPO, shares are being traded freely in the open market at what is known as the free float. Stock exchanges stipulate a minimum free float both in absolute terms, which is the total value as determined by the share price multiplied by the number of shares sold to the public, and as a proportion of the total share capital. This is the number of shares which are being sold to the public divided by the total number of shares outstanding. Although IPO offers many benefits, there is also significant costs involved, mainly these associated with the process such as banking and legal fees. Also with the ongoing requirement to disclose important and sometimes sensitive information. Details of the proposed offering are disclosed to potential purchasers in the form of a lengthy document known as a prospectus. Most companies undertake an IPO with the assistance of an investment banking firm acting in the capacity of an underwriter. Underwriters provide several services, including help with correctly assessing the value of shares, which is the share price. They are also establishing a public market for shares, which is the initial sale. Alternative methods, such as the Dutch auction, have also been explored and applied for several IPOs. Is this video still going on? Let's see some of the history of IPO. The earliest form of a company which issued public shares was the case of publicani during the Roman Republic. Like modern joint stock companies, the publicani were legal bodies independent from their members, whose ownership was divided into shares or partes. There is evidence that these shares were sold to public investors and traded in a type of over-the-counter market in the forum near the temple of Castor and Pollux. The shares fluctuated in value, encouraging the activity of speculators and questors. Mere evidence remains of the prices for which parties were sold, the nature of initial public offerings, or a description of stock market behavior. Publicani lost favor with the fall of the Republic and the rise of the Empire. In the early modern period, the Dutch were financial innovators who helped lay the foundations of modern financial systems. The first modern IPO happened in March 1602 when the Dutch East India Company offered shares of the company to the public in order to raise capital. The Dutch East India Company, or VOC, became the first company in history who issued bonds and shares of stock to the general public. In other words, the VOC became the first publicly traded company because it was the first company who was to ever be listed on an official stock exchange. While the Italian city-states produced the first transferable government bonds, they did not develop the other ingredient which is necessary to produce a fully fledged capital market, which is corporate shareholders. Whew! Before we continue, please pause the video and hit the like button as it helps me tremendously to build this channel. Also, if you don't have a portfolio but you want to start building such, or you do have a portfolio but you're not happy with your current broker, have a look down in the description. The exchanges you see there are trustworthy and they charge fair fees. Depending on which one of them you decide to go with, they might even give you a welcome bonus. Or you can go with all of them, as I always advise traders and investors to use at least a few exchanges for an extra layer of safety. As Edward Stringham notes, companies with transferable shares date back to classical Rome, but those was usually not enduring endeavors and no considerable secondary market existed. In the United States, the first IPO was the public offering of Bank of North America around 1783. What are the advantages and disadvantages of initial public offering? When a company lists its securities on a public exchange, the money paid by the investing public for the newly issued shares goes directly to the company, which is called primary offering. They also go to early private investors who opt to sell all or a portion of their holdings, which is the secondary offerings, as part of the larger IPO. An IPO therefore allows a company to tap into a wide pool of potential investors to provide itself with capital for future growth, repayment of debt, or working capital. A company selling common shares is never required to repay the capital to its public investors. Those investors must endure the unpredictable nature of the open market to price and trade their shares. After the IPO, when shares are being traded in the open market, money passes between public investors. For early private investors who choose to sell shares as part of the IPO process, the IPO represents an opportunity to monetize their investment. After the IPO, once shares are being traded in the open market, investors holding big blocks of shares can either sell these shares piecemeal in the open market, or they can sell a large block of shares directly to the public at a fixed price through a secondary market offering. The type of offering is not dilutive since no new shares are being created. Once a company is being listed, it is able to issue additional common shares in a number of different ways, one of which is the follow-on offering. This method provides capital for various corporate purposes through the issuance of equity without incurring any debt. This ability to quickly raise potentially large amounts of capital from the marketplace is a key reason for many companies to seek to go public. An IPO accords several benefits to the previous private company: enlarging and diversifying equity base, enabling cheaper access to capital, increasing exposure, prestige, and public image, attracting and retaining better management and employees through liquid equity participation, facilitating acquisitions potentially in return for shares of stock, creating multiple financing opportunities like equity, convertible debt, cheaper bank loans, etc. You realize I cannot even remember my lines when I see you picking up your nose, right? There are also several disadvantages to completing an initial public offering. Significant legal, accounting, and marketing costs, many of which are ongoing. Requirement to disclose financial and business information. Meaningful time, effort, and attention required of management. Risk that required funding will not be raised. Public dissemination of information which may be useful to competitors, suppliers, and customers. Loss of control and stronger agency problems due to new shareholders. And last but not least important, increased risk of litigation, including private securities class actions and shareholder derivative actions. When you're done picking up your nose, can you come show me who do I give the £100 to? But don't you dare touch the screen. And the £100 goes to you, mate. Now you have more than nothing, my friend, and use it wisely. Thank you all for watching this video. Make sure to subscribe if you want to have a chance of catching a giveaway yourself, and I will see you next time.